All right, stocks finished the week on a high note. Really good 3-week run that we've had here to rebound off of last options expiration, where we had those clusters on the S&P 500. The question, of course, has been the strength of this rebound. With the ideal scenario was to try to start to get some renewed strength over the course of this week and kind of put to bed some of these red flags. And the problem is these red flags kind of got worse as the week has gone on, because even though we have been up most every day this week on all the indexes except for the S&P, we had like one slight down day, but we finally did get up to a 5% move up off those low points. So we are on an intermediate run. The question is, of course, what the actual return will be by the time we're done with this intermediate run. The last one, we won 27% without a 5% decline. The one before that, we went 19% without a 5% decline. How far will this one go? That's the question. And if it's going to be right around this 5% number, then and we fail, kind of like we saw last summer, then there's a good chance we make a run to lower lows and the 200-day moving average again, like we did last summer. Or is there is a more likely probability, which I think is going to be the case, that we continue higher. So I'm going to break down again those red flags, why they're so important, what we need to see to get rid of them so that we can expect a bigger return, a longer rally where a lot of the stocks can get swept up in the bullishness, especially as we're ending the earnings cycle and start pricing in the next earnings cycle. So I'll break all that down, what's driving this action, some interesting moves in the dollar and yields today, and then our trade idea of the day. We'll take a look at a stock that's rebounded really nicely. It's part of the reason why the Dow's been so strong, and we'll talk about how to trade that. So let's go ahead and get started. Today is Friday, May the 10th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Be able to check out things, all the other trades. We've actually closed out a couple more trades here today. Some old Market Outlook trades that we got into. I talk about why we put on today's trade idea already before the market closed. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. It's a big deal to us. Is why I always ask every day. So thank you to those who do this day in, day out. Those who don't, you can do right now while you're watching with 1 or 2 really easy clicks. Help us get to our 100 likes goal on the Market Outlook tweet. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we finished another day higher. So I think, aside from like this day, which ended up being 0.03 of a point lower, and finished higher than we opened. So it's technically a down day, but the reality is it's pretty much an update. And it was an update on all the other indexes. So you're looking at pretty much an update every day this week, including the last 2 days of last week. It's a pretty good 7-day rally here up to the upside. If I were to take a look at the rate of change, like we always like to do here, just to kind of get an idea of just how bullish this move has been in the past week plus, we're looking at about a 4% gain. That's not bad. Again, it's not the same as what we saw there. That started that rally. Let's zoom out a little bit here. Obviously, that rally there in last year ended up a little bit bigger than what we had right now. And if you look at this rally here, it was also just a little bit bigger than what we saw, but almost about the same level as what we're seeing right now. So, a pretty decent move to the upside. Some of these moves are a little bit bigger, of course, but those fail, right? This one failed. So here's your 4%. That failed. This failed, even though you had a much stronger run. So you had a stronger run here to come off of that low point over 7 days than the 4% right about here, as well as there. So needless to say, it's a weaker rally. It's not incredibly weak, right? It's just we've seen bigger moves off of lows in this, but we've also seen bigger moves off of lows in this that failed, right? Even over here. When you look at this move here, it was basically just about the same kind of move we're getting right now. It was a little bit over 4%, 5.7% is what that ended up being over 7 days. And remember, that's the same kind of move we had. We had a big, long, extended run. We had a 5% pullback just to basically say we had 5% decline. And then we rallied almost every day, similar to what we're seeing now. We kept going up to the end of the year and ultimately failed. Remember, the Russell 2000 pulled back a little bit earlier than that. Oops. Again, there we go. Pulled back a little bit earlier, right? So it didn't quite get up, a little bit bigger of a pullback during the S&P. And we saw that today. The Russell was down a little bit more today, but one day is not make a trend, obviously. But we've seen this kind of move before. Again, it's not too weak, but it's not strong. It's not as strong. Like you can see over here when we started this one. If you take a look at the last two bullish moves that we've had, we only had a yellow line for what, 1 day there, and then it turned green immediately. And then on this one that rallied 19%, we had a yellow line for 2 days, and then it turned dark green shading and a green line. So we've had a yellow line now for 5 days. And depending upon how bullish we are on Monday, probably will stay yellow on Monday. Now, there's a good chance it turns green finally on Monday, and we'll have our dark green shading and a green line. Again, the intermediate line has crossed above market sentiment. It's not in the upper reversal zone yet, but it's really darn close. So most likely will be on Monday. Again, barring a big drop on Monday, of course, which is unlikely because the market doesn't move very much on Mondays. Your near-term line has been in the upper reversal zone all week. That's a very good sign. To get that. Remember, the momentum line had gotten up there before, and that was a good sign. Momentum line is down now, but it's not embarrassed, nor is at extremely low levels. So that's okay. We're not 2.5% above. That's the kind of mark that you need to get above to really get trending to the upside, and that's why we haven't turned green yet. When you look at it over here, for an example, the reason why it turned green so fast is because we did have such a strong move from a very significant low point up to this level. So the problem here is we weren't as sharply lower here on this last near-term low point. And so because we weren't as bearish, now we're not as bullish, and that's why we're not getting such a significant change here. Looking at the weekly version of the market forecast, short-term sentiment's really improved after being pretty oversold going into that options expiration. Now we've had 3 straight weeks to the upside. We have not reversed the 3 straight weeks to the downside that we had. So we have there's 3 moves here. The short-term sentiment lines again are kind of working their way up. The near-term line is in the upper reversal zone. The intermediate line is still above market sentiment, so everything is still good from that perspective. When you look at some of the other indexes here, especially the Russell, let's take a look at the Russell because it was actually down today, 0.2%. Again, it's got dark green shading, but its intermediate line is also above market sentiment in bullish territory, but not threatening to get in the upper reversal zone. And you can see the down day we had today. We're not up that much this week, considering that bear tag that we got last week. And again, the momentum line is oversold, but not extreme, so it's not too concerning yet. And the near-term line is not in the upper reversal zone anymore. It's in bullish territory, but it's not in the upper reversal zone, so not as bullish on the Russell. Now, the Dow is the one that's been the most bullish. In this past, in fact, it's been up 8 straight days when you count May 1st when the S&P was down. The Dow was up that day slightly. And then, of course, the one day that we were down just a little bit, it was actually up too. So 8 straight days to the upside. For the Dow Jones. Your near-term line's at extremely high levels. Your intermediate line has crossed above market sentiment, though remember, it was more bearish to begin with, this streak with, and so it still hasn't crossed into the upper reversal zone yet. It's in bullish territory. So we're not quite there. And if you look at the weekly chart, we got a cluster. Yeah, how about that? We had a 3-week decline, we have a 3-week rally, and we're right back to having an oversold cluster on the Dow Jones Industrial Average. Now, that doesn't necessarily mean that we have to now start falling, but it does kind of show just kind of how overbought we are in the very short term here. That was a significant move to the upside. Let's look at the NASDAQ 100. Again, 3 straight weeks to the downside, but really most of that downside is 1 week. We've recovered that entire week. Short-term sentiment has recovered, so things looking better, better from that perspective. If you look at these other weekly charts, again, we ended up with a bullish candle this week, pretty decent size, not majorly, but big enough, right? We closed above the Hakinyashi close. Next week's Hakinyashi open will be right around 51.40-ish, plus or minus a few points. We're trading at 52.22 right now. So we'll get a pretty decent bullish candle next week. The high here is at 51.86, or excuse me, 52.39, sorry. So we're just a smidgen below that high. So we have a pretty decent chance next week of getting another bullish Hakinyashi candle. So things are looking good from a bullish standpoint from that perspective. If you take a look at the whole, I'm going to look at the whole moving average as well on the weekly, kind of round out our weekly charts that we look at. We have flipped the parabolic SAR back down to the downside. So positive sign there. You can see the PPO is almost crossing back above its moving average, though the moving average is already pretty elevated as it is. So it limits the upside, but it's kind of similar to what we saw over here in 2021, where we had a few weeks to the downside, we flipped it back up, and we had a limited upside. We got up to new highs, but of course we were still kind of in convergence mode, so you wouldn't expect that we'll go too much higher here, considering how high we already were just to get to this point. So again, limited upside here on this current intermediate rally that we're on. Most likely not going to get to 27% again before the next 5% decline, or even a 19%, which is what we had before that. Those are the last two intermediate rallies. 3 green arrows across the board, establishing a good trend. The MACD histogram's rolling over on a couple of these, but nothing too significant, right? We're not threatening a red arrow anytime soon, much less 3 red arrows. We're well above moving averages here. The 8 and 17 day have now crossed the 30, very bullish sign there. As I said before, the MACD histogram is not very tall, so we didn't have a whole lot of momentum here. And the MACD is not very tall. When you look at, again, the initial momentum surges of the last 2 intermediate rallies, the MACD peaked here, which is, again, much higher than where we're at right now. And the MACD peaked on this one over here, which is just a little bit higher. And then we got another surge after this convergence period. We got another surge, which really kept it going. That got a lot higher. So again, usually the MACD peaks after the histogram. So if the histogram is close to peaking now, that means the MACD may be close to peaking too. Doesn't mean we have to start rallying, right? We can be in convergence mode and still be pushing higher. But it kind of suggests that, if this is the big thrust that we have to start this bullish move, it's kind of a weaker thrust higher. Let's take a look now at some of the other oscillators. We'll look at the DMI. Again, you can see we're above 30, below 25 on the negative, but at least now we're above 30 on the positive, so that's a good sign too. To get a good bullish move established here. The ADX is down. It will turn back up if the negative indicator will start to fall more. Remember, the Russell 2000's not as bullish, but it has a pretty decent pattern on its DMI too. So things are looking pretty good from that perspective. The RSI and the CCI, we finally got above 60. We got above 60 actually yesterday, and we stayed above it here. We're still above 100 on the negative, so now this can stop, right? We can stop right here on the last day that we were above 50, so it would be, actually we need to go back to, but here we can stop the red part here and then start a new green RSI move now that we're above 60. Again, it might not be too long. You can have short ones. I don't know how far back I've drawn these charts, but you can kind of see the intermediate rallies that we've had. There's that one, again, that went 19%, and one that went 27%. You can see what their RSIs do during those rallies, and this one can still continue to be green because it's based off of that weekly CCI, which is nowhere near dropping below. In fact, has rallied back up to almost 100. In fact, I would venture to guess we'll cross back above 100 next week. And you can see the weekly RSI is still very strong at bullish levels. Looking at the Ichimoku cloud, we are now clearly above the cloud. That's a good sign too. Again, if we want to be up here when we get to the pink shading, which is only a few weeks away, so we're above both lines. The green line's crossed back above the blue line, and we don't have a trend developed yet, but we're getting closer to at least having a weak trend developing here. IWM, of course, does have a weak trend developing, but we're still in the cloud. Green line above the blue, and you're still kind of flirting with positive rate of change here, but we're slowly turning in the right direction on that one. And you can take a look at the Bollinger Bands. Again, we're easily in the upper quartile. We're not pushing up against the upper band, but at least we're in the upper quartile. The band width is rising again. The momentum is increasing. We have green dots, which means the bands are outside the Keltner channels. We're not outside the Keltner channel yet on the actual index, but again, we're getting closer. So you can see very, very good signs. They're not the best. We're not like, again, it's not the strongest momentum move here, but at least it's in the right direction to where we're getting a lot of good signs. The issue is, again, how long, and I tweeted this out and asked for a poll on this, is, now we will have a green box. Like, this is now green. It's not orange anymore. We have a 5% close. So it's going to be green now. Now the number inside the box can change. It can keep going. It can't go down below 5%. It can't go down below 5.14, but it can go up. If we keep going up, it can get bigger. So the question is, how much bigger will it get? Will it get into the 5 to 7% range? That's kind of what I tweeted out here. Will it get into the 5 or 7% range? I mean, that would be a failure. That would mean that basically we're already done or really close to being done in this current move. And essentially we would probably end up moving back down to a lower low and working our way to the 200-day moving average. Again, that would be very similar to what we saw right here, where we get rallied up. We went down like, I can't remember what that ended up being, about 4.78%, I think. And then we rallied like 3%. So it'd be something similar to that. The 8 to 10% rally would be kind of a weak intermediate run where the number ends up being 8 to 10%, but at least it's up to higher highs, right? At least it will take some time. This is your typical intermediate run that will last 1 to 3 months, probably like more in line of 2 to 3, and this is like what we've seen the last two times: big, strong 19% move, and then 27%, multiple months. Remember, the typical range is 1 to 3 months. So anything above 15%, you're looking at kind of a longer than normal run to the upside. So not a lot of people are expecting a longer than normal run. Not a lot of people are expecting a normal run. Most people are either expecting a very weak intermediate rally to the upside or a failure, right, where we fail at these highs and work our way lower. So it's kind of interesting to see the votes showing up there. I'm in the camp of that we'll probably get to the 8 to 10% mark. But we need to be aware of the failures, though the odds of that failure is starting to really fall because of the continued signs we've been getting here this week. Now, next week we got CPI, and next week we have options expiration. We have earnings a week after that, especially with Nvidia. So there's some few things on the plate, but at least we're going into those things in the positive direction here. Let's look at the intraday chart. Here we go, the intraday chart. We did get a new 4-week high point, so we're still at 100 on the Arun indicator. We're moving the low further over to 0, so good sign. We're not, we're actually increasing the size of the channel a little bit. It's still pretty low, but it's moving in the right direction. And again, like I said, small ranges here. Those small ranges have brought the ATR almost back down below 1%. But remember, getting below 1% is actually a good sign. On one hand, as you can see here, we got below 1%, but the volume was a lot higher, so we had some more room to go. The volume's already extremely light. The volume's been very, very light here. And you see that in the normalized volume. When you look at the money flow, it's just been very weak, and that continues to be the reddest of red flags, that we're not getting a lot of momentum on this current rally to the upside. If you take a look at the VIX, this is the other red flag. The VVIX is at the low. This is the lowest level. The VIX itself, almost at 12.5, almost down to 85%. Again, last time we got to 85%, that's when we bottomed, and the VVIX was actually barely below 7, but still above 75. So we're even more extremely low now than we were then. And so this kind of pop, whether it's going to come after expiration or before, next week before or the week after, this kind of pop to the upside in volatility is very likely. Again, considering how low the VVIX is and how low volatility is itself on an absolute basis at 12.5, but also how low it is below, like, say, its 30-day moving average, 30-day average value. It's one thing to be this low, as we are about almost 20% below. We were down here, we were this low, but the difference is the 30-day average is way up here in the high teens, and the 200-day average was in the high teens. Now the 200-day average is below 15, and the 30-day is barely above it. So it's, that limits the downside when we're already this low. And like I said, the VVIX is as extremely low as it is. Again, it's suggesting we don't always V bottom on the VIX. A lot of times we just flatten out. So that's a possibility, and that would be more in line with the 8 to 10% rally. We just kind of flatten out here and converge. But there's also this alternative where, again, like over here, we started the decline. We failed with that subsequent rally. Part of the reason why we failed is because volatility was so low, and then we went to a new leg lower. And so this kind of move is more in line with that 5 to 10%, where we fail and we make a run towards the 200-day moving average in the S&P. So it's a low probability scenario, but it's still on the table, and we need to be aware of it. And like I said, next week will be kind of key to see whether we can finally take it off the table or not, and see how much we ultimately end up going up here on this run. All right, now let's take a look at what's driving this price action here. And as always, this continues to be a very similar theme. Let's take a look at the asset class comparison chart first. You can see gold rallied, has been rallying the last couple of days. It's been so bullish, remains to be strongly bullish here. Bonds dropping. Let's look at just today alone first. So bear with me 1 second while I do that. You can see gold again, big as outlier to the upside, and has been the last couple of days. Bond yields were up today, which is interesting. It put some pressure on equities, but didn't push them lower. The dollar was up. Again, that typically puts some pressure on equities. Of course, did not push them lower. IWM, it did impact IWM the most. So the Qs ended up rallying slightly. IWM ended up being the biggest loser for the day. If I go out to the week, you can see gold was the big winner on the week. Again, big move over the last 2 days to the upside, and that's despite some strength in the dollar. Yields were down for the week, even if they did rise a little bit today. You can see high yield bonds ended up being the bigger loser by the end of the day. Let's take a look at some of these risk appetite ratios here. Let's come over here to the ratio charts. Oops, sorry. Let those load up first here really quick, and then there we go. Take a look at these. Few risk appetite ratios that we need to kind of be aware of. One of them is discretionary relative to staples, and you can see it was down again. It's already below the 200-day moving average. Actually, this is a weekly. It's actually below the 200-week moving average. But you can see it has broken down below the 200-day moving average here, and it went down even more today. So you can buy the last few days, actually. So we're really dropping. This is a really important ratio because it's discretionary stocks, consumer discretionary relative to consumer staples. It's obviously when you're above moving averages, you're bullish, but when you're below, especially on the death cross, not so good. We've also been looking at utilities relative to the market as a whole, breaking above that 200-day moving average. One other ratio to watch utilities against is actually against financials. This ratio here is typically correlated with risk appetite. It's broken its 200-day moving average. So the financial stocks have really had a rough go of it in the last month plus relative to utility stocks. Utilities really gaining big time to the downside. Again, that's not typically a bullish pattern. Technology has been your big winner, and you can see has, again, still below its 200-day moving average, and you're close to a death cross on it. It was up today, but still below its 30-day moving average. It's still falling, and the 50-day is still falling, and your MACD is up but not positive. Your RSI is up but not in the upper half of the chart. Your CCI is up but not above 100, and we're just not that strongly bullish on technology, and that's you kind of need to be for things to really take off. You can see, in fact, utilities actually improved this week, and if I look at the whole week. Here, let's update the chart so we can get the whole week picture. So you can see staples and utilities were dropping, but utilities rebounded today in a big way. Staples still in weakening category, has not made its way over here like energy has. And you can see financials have also weakened here despite the strength in utilities. But technology, which has been rebounding pretty well, slowed down today. Discretionary, which has also been doing pretty well. It has gotten to the leading category, but now is losing momentum. We're not like that. We've had a little bit of a pretty decent move early this week in some important sectors, but they're not continuing to show that strength. If you look now at the sector comparison chart here, where is it? Right here. You can see again, if I just go off the whole week from the beginning of the week, you can see utilities, big winner. Financials have been a big winner, but again, not versus utilities. And then you can see discretionary way down here at the bottom, technology underperforming on the week, communication services barely matching the markets, not the kind of move. And if I go out to the full 3-week period that we've been on here, since those clusters that ended the expiration cycle in April, technology is a big winner, but not utilities outgaining technology is not typical on a nice, good, bullish intermediate run. So for an example, if I were to go out to that run that started post Halloween, so here October 31st of last year, going forward, again, you can see utilities did not lead the way higher in that first little bit. It was technology and discretionary and communication services, financials to a degree, real estate. Remember I said it's been acting like a tech stock. So those are the stocks that typically lead higher. And that has not been the case this go around, right? This particular intermediate rally has begun with utilities being the big winner, and that's again not typical. We've had good breadth for most of this week. It deteriorated a little bit today, but not too bad, right? You're still above 35 on the McClellan oscillator, and if you look at some of these, like the new highs and new lows index, you're still above 100. You're above 250 actually. The number of stocks above the 50-day moving average jumped up a little bit today. Again, we got a little bit of divergence going on the 5-week rate of change. It's starting to slow down again. When you break the moving average, you want to break with a strong move higher to the upside, not with a divergent high point. So another red flag, right? The volatility, the volume, the volatility, and the breadth. From this standpoint is a few red flags, including you could also say some of the ratios here are some of the red flags that again just suggest that at best we probably will get an 8 to 10% rally where it's a weak intermediate run to the upside, not your typical length, more like maybe 6 weeks, off of those. We're already 3 weeks off of those April lows. Or we might be done now, like we might be done going into expiration here, but we're just getting maybe a 5 to 7% move and where we fail. So now you can see why most people pulled in those numbers, because there's still a lot of red flags that just suggest how weak this move ultimately will end up being, and when, and how, again, if we go 8 to 10%, then the next intermediate decline most likely won't get to the lower lows. But if we stop at 5 to 7%, then the next intermediate decline probably will produce lower lows and work its way to that 200-day moving average. So that's a big distinction that we need to be aware of, and we need to really clear these red flags off the table by the end of next week, ideally. All right, now let's take a look at UNH. It's our UNH is our trade idea of the day. It's in the healthcare sector, obviously. United Health, big name. Had a really huge decline going into its last earnings, but had a good earnings report. The market liked it, at least, and it's been on the bullish move ever since. Kind of back up into where most of the range has been for the year, up to the upside. If you take a look at the weekly chart, you can see you've had a few weeks. This is like the 4th week now. You had a big transition week that obviously was bullish, and then you've had 3 good bullish candles. A little bit of a transition candle last week, and then we've reversed that completely with a strong bullish candle here this week. So a good move up to the upside. You can see that you've got green shading. We've had 3 green arrows for a while now. We're back to 3 green arrows again. If you look at the 2-line version of that chart, you can see we have crossed above the 200-day moving average. That's a good sign. Again, above the point of control. Again, where most of the volume of this year is taking place has been in this area here. So we were well below the value area at one point in time, and now we're back easily into it. If you take a look at some of these other oscillators, let's start with the DMI first. You can see you're going to have bullish patterns across the board here, above 30, almost below 20 on the negative indicator. When you look at the RSI and the CCI, this is one of the reasons actually why Dow has been doing so well. You're above 60, you're above 150, so good bullish candle or bullish signs from those indicators. The Ichimoku cloud, you can see we have an intermediate trend strength. We're above the cloud, green lines well above the blue. So good bullish patterns here all across the board. They get back from where we were pretty strongly bearish, right? You're back above the point of control. The bandwidth was big because of that big move down to the downside. We've rebounded and kept the bandwidth pretty strong, and now that bandwidth is falling like a rock. And you can see the bands themselves. Look at that lower band moving up rapidly. We are pushing up against the upper Keltner channel, not breaking out necessarily. The upper band is really dropping. Usually when you got bandwidth like this that's been so big, starting to move lower like this, for example, you start to kind of stay in a sideways pattern here, especially in this case because our point of control is actually down here. You've got some pretty strong support. So what I decided to do here for our trade was to look at an iron condor spread. Sell the 490, buy the 480, sell the 540. So low 20 deltas on both sides. Buy one, strike away. This is what the trade looks like. We put this trade on. Put those lines onto the chart. Lower than normal risk because it is $10 wide spread. I'm getting a decent reward for that risk. And then there's where my break evens are. So I like where those break evens. I got room to the upside if we were to maintain a bullish trend and keep going. But I've got some strong support to the downside now that we've broken up above here. In fact, you're probably by the time, if we were to retest this area, 30-day moving average might be up there by then. So we got very strong support, room to go to the upside, and a pretty decent reward for less than normal risk to get that reward. So like the setup for this particular trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody, and we'll see you all on Monday.